Good morning and welcome to the Australian Early Finance Briefing for Friday, the 3rd of July. I'm Nick Hurley. So today we're going to start with a write-up by a former portfolio manager at AQR, the quantitative beta hedge fund, Aaron Brown. So he's done an analysis of the dividend futures on the S&P 500, and it shows that there's it's pricing in a 30% decline in cash flows for the members of the S&P 500, with very little growth all the way through for the next 7 years. So not until after the year 2027 will cash flows start to expand to the predicted pre-virus levels. But paradoxically, the S&P 500 is up 34% since the coronavirus bottom on the 23rd of March. He hypothesizes that there's three possible explanations for such a divergence between dividends and the prices of stock. One is that investors expect companies to generate good profits, but to use those earnings for reinvestment, cash hoarding, debt reduction and buybacks, which is obviously what we've seen prior to the coronavirus pandemic. Second is that investors expect that an exceptional period of growth for more than 10 years going into the future, obviously not very likely. And the third is that investors have decided to accept lower long-term expected returns than they demanded prior to the pandemic. So he says that the first one about the buybacks and hoarding cash is probably likely to some extent, and we've seen a number of corporates sort of indicate that they plan to resume buybacks. JP Morgan, for example, is one of them. He likes his third and final hypothesis that the increase in stock prices are more an example of an expectation of lower returns, a tolerance of lower returns going into the future. He says, I don't think lockdowns or isolation can explain 7 years of flat dividends. The culprits are more likely to be the long-term disruption of supply chains, reduced global trade, less efficient companies with more working from home, political instability and macro fallout from crisis spending. So obviously a number of those factors there do have negative connotations for other asset classes such as government debt, corporate debt, currency. So it explains part of the appeal of equities. So even at reduced expected returns and a higher volatility, the ability of stocks to recapture most inflation and prosper when nominal assets, real assets, and government assets are struggling, it can make them seem somewhat of a safe haven. He also highlights that the public health impacts of the coronavirus have been improving. Obviously, not just the loosening of lockdowns, but the mortality rates, the treatments. He also suggests that there's more permanent sort of fundamental shifts in the corporate sort of realm, where companies such as more value-oriented stocks are not going to be generating the incomes they did going into the future. He says investors are betting on companies that are investing for future profits and are better tailored to this stark new world. And stocks, because they're on alone attractive, but relative to many other asset classes, they do seem, particularly for growth factor, that they're one of the least worst of things to invest in. Okay, moving on to rates. James Bullard, the president of the Federal Reserve Bank of St. Louis, has done an interview with the Financial Times. He says, even though we got past the initial wave of the March-April timeframe, the disease is still quite capable of surprising us. Without more granular risk management on the part of the health policy, we could get a wave of substantial bankruptcies and that could feed into a financial crisis. He sees no justification in sort of giving a forward outlook for rates. He's very much comfortable with the line of, look, the Fed will do whatever it takes as long as it takes to keep rates low, and that's good enough for markets for now. The FT also mentions that the Fed now has 2 facilities in place to buy corporates in the primary and secondary markets, including junk grade bonds, which the US Federal Reserve has never done that before, and it's something I was surprised to read as well. Moving to markets now, the New York NYC has opened about 25 minutes ago. The S&P is up 1.2% on the stronger than expected jobs report. I'm in at 11.1% growth. That obviously is positive, but it should also be taken at the same time as announcements that California, where there's been a large outbreak in coronavirus, yesterday there was 50,000 new cases in the US, that they're closing down restaurants, and they're finding indoors is where the transmission's occurring, and that's going to obviously have a huge impact on employment. So that's probably something to just be taken slightly cautiously. And that is your early finance briefing for Friday the 3rd of July. Have a great end of the week. Good morning and welcome to the Australian Early Finance Briefing for Thursday the 2nd of July. I'm Nick Hurley.